In today's video, we are going to look at a case in which an individual is interested in a high cash value life insurance policy. He's interested in funding the policy anywhere from $15,000 to $30,000 per year, and he'd like to use the policy to pay off some real estate debt that he presently has. So let's begin with some basic details. What we have is as follows. He is 49 years old. His wife is 48, if I am not mistaken, but he's interested in a policy for himself. The funding amount is anywhere from $15,000 per year to $30,000 per year. The maximum time frame that he'd like to fund the policy is 15 years. But he might not want to go that long, because think about it. If he's 49, 15 years takes him up to what? Just about 65, until the age of 64. So does he want to fund that long? Right now, yes, but at the same time, he wants the option to hit the kill switch and stop early if that's what he decides to do. And we're gonna go through an example on that too. He's interested specifically in MassMutual. You know that he has done his research, not from the fact that he wants to go with MassMutual. They're a good company, but just from the initial email to us and a little bit of back and forth, it was apparent he had been doing research. He's got a good sense of the company and product that he is interested in. He likes their 15-pay policy. And I did consider the higher cash value in this case, but being that 15 years is going to be the longest period of time, the 15-pay does make sense there. So what we're going to look at specifically when considering the $15,000 to $30,000 per year funding are two examples that show exactly that. So what I would show first here is the 15K per year. Let's do it this way. Let's go purple. So we'll call this option A, 15,000 a year for 15 years. And we'll look at how much he paid in over the course of the 15 years, the cash value performance, and also the death benefit over time as well. Then option B, what we'll look at here, is $30,000 a year for 15 years. We'll look at the same thing, total amount in over 15 years, which would be $450,000, cash value and death benefit performance. But then we're going to look at, let's call it B2. And I call it B2 because it's the exact same policy. It's equipped to handle $30K per year for 15 years. But what we're going to look at is $30K per year only for 5 years. And this one I liked a lot. The reason why is because he mentioned that he's interested in using the policy to pay off what? Pay off some real estate debt. So he's got a mortgage outstanding that his preference would be to clear this and then have a loan against his policy and then pay that policy loan off over time. So if he wants to pay the loan off quickly, obviously it makes sense to fund the policy with a larger amount, if he has the means to do so. This is why we show options. We don't want to assume, hey, just go with the high-end option because you're going to be able to pay things off faster. Well, yeah, if we go with the high-end option, we have more money. Of course, we can pay things off faster, but we're not all there, or at least not yet. It takes time. But from a loan perspective, what we looked at was this, using B2, so funding it more aggressively, but then knowing that we can stop early. So here, this is a comfortable funding amount. If we look at 15,000 times 15 years, that gets a total of how much into a policy? $225,000. This will get $450,000 in. But then option B2 gets how much in? $150,000. So it's the least amount, but over a shorter period of time. Where the shorter period of time is appealing to some people is when it comes time to taking policy loans. If I no longer have to fund the policy, I still can if I want, but if I no longer have to, I can just dedicate any resources, if it's still $30K per year, if I've got that in cash flow, now I can look to use that to repay loans instead of funding the policy. This way I can clear the debt first, and then if I want to resume funding, we can do that as well. There are some limitations there, however. If I have a 15-pay policy, how long is the premium due? 15 years, hence the name of the product, a 15-pay policy. But that's something we would discuss. So let's take a look at the numbers here, and we'll look at the different scenarios. First, I just want to highlight something which is great information to be aware of. So here's our 15-pay illustration And this is based on the 15,000. We got a 15 pay with 15,000. We got a lot of 15s here. All right. So here's your annual outlay. It's the same as annual net outlay. But as you look at this, the question I always ask, meaning if I'm you, I would ask this question to your agent. Where is my money going? Because where can money go? Premium or the PUA rider? What's the name of the game to maximize cash value? Minimize the premium, maximize the PUA rider. Here's your premium, $2,600 and change. It's almost $2,700. Mass Mutual will typically allow us to set a minimum premium just about 10%. 10% of 15,000 would be what? $1,500. Why is it higher? The reason why is when we design a policy and we've got certain riders attached, such as this LISR, the minimum whole life death benefit is $50,000. And then for a 49-year-old male, he's actually 48, he's 49 at the end of the first year. But for a male his age, that minimum whole life death benefit gives him a base premium of $2,700. So it's higher than the $1,500. So is this as optimal as it can be? No. Does it still perform nicely? Yes, in my opinion. At year 5, you're just about there, being the break-even point. You've paid in $75,000, and you've got just about 75. You're at 74 and change by year 6. You've got more in cash value than what you paid into the product. For using a policy, pay off debt, early cash value is key because you can pay the debt off quickly. I always like early cash value. I like strong long-term cash value too. Let's look at the next scenario. So the nice thing about the 30K sample is because now, based on the level of funding, 30K per year, 10% premium results in a whole life death benefit greater than the $50,000 minimum. So I'm able to achieve the design I want here. And as a result, a little bit stronger break-even performance and such, more cash value up front from a percentage standpoint. But this is not something we go through all the time. If we're dealing with a situation where a funding amount that someone's considering, a 10% base premium, is not achievable, perhaps based on their age, a health rating, the total amount they want to pay, whatever, we do want to go through those details because typically what individuals are interested in, at least that work with us, is maximizing the cash value and also the flexibility. Because if you want flexibility to scale these payments up and down over time, because you can do that, premium's often the minimum. So the lower the premium, the lower my minimum commitment is, and therefore, the less it feels like a bill. All right, so let's look at a comparison. 15K MEC limit, 30K MEC limit. Look at the center example, option B, and then the example to the right. Look at the first 5 years. Do you notice any difference with those two? No, because again, they're the exact same policy. The difference is that we are stopping the funding here. And you don't have to stop, by the way, either. We could just reduce it, maybe starts paying in $5K a year. But typically when we look at loan scenarios, what we found has been very valuable, especially in the beginning when I'm trying to grasp how the growth in a policy works, how the loans work and such, is to look at loans when I'm not funding the policy. This way I can just visualize what am I paying in, and then what am I taking out in loans, and what am I paying back in loans. There's a lot going on, so how do I just isolate it and move through one item at a time? In reality, we can borrow while we are funding, and a lot of people do that. But where we like to start is with something like this. So now, on our loan workbook, we've got the 5-pay scenario. This does not demonstrate exact policy loans coming from a life insurance policy. This is a workbook we put together that gives you a quick on-the-fly sample, and you'll see very similar results if we ran this in the illustration software. This is meant just to be a quick reference that clients can use. What I like about it is the fact that when you plug in an illustration, you plug in these columns, and everything to the right populates for you. So you've got your IRR, yearly cash value growth, total gain on cash value, 95%, so LTV, loan to value at 95% of cash value. This will pull 95% of whatever that cash value is, which is typically the amount we have access to. So let's look at some loans. He wants to pay off some real estate debt. Outside loans, $100,000. How soon can he access $100,000? If he wants to take it out in one lump sum, policy year 4. If he wants to chip away at it sooner, can he do that? Yes, he can absolutely do that. Why don't we do this? So he can take out 100 lump sum in year 4, or what's the maximum loan he can take year 1? $25,000. Why don't we do this? 25 for 4 years. In year 4, he's probably going to have to take less than $25,000 because that loan balance will be less. If he's paying down an outside loan faster, he's going to chip away at the interest faster. But my point is, you can do it sooner. So here we go. Loan balance is $100,000. Here's a very, very important piece to point out when you're looking at loans from anywhere. What's your annual interest? We're assuming he pays it out of pocket. $1,375. What did the policy grow by in this year? Circle this in black. Negative $3,471. The reason why is because he paid in 30, he had $26,500 in cash value. That's a loss. So he had a loss and he paid the insurance company interest. That's a drawback in this particular case. We're in some ways shooting ourselves in the foot. How about the second year? Negative cash value growth, meaning year 1, you're at 26, you paid in 30, then you're at 55. If you got the full 30 back, you'd be at 26 and change. Lost money. And I took out another loan, so I paid more in loan interest. Total interest, you've paid over 2 years, $4,125. Total gain on the policy, negative $5,000. Add those two together. Yeah, you're close to $9,000. Actually, a little bit over $9,000. Continuing on, next year, all right, no longer in the red from a growth standpoint, but you're taking out loans, so you're going to continue to pay more in loan interest. Here we go. We funded the policy for 5 years. By the 5th year, what's going on here? Your annual growth is starting to look better, catching up to what you're paying in loan interest. Still paid $5,500, where the growth was $3,786. Now, year 6, you're no longer funding the policy at $30K per year, so you can begin to attack the loan. Now you're paying loan interest, so let's assume that he attacks it at $20K per year. He's got a lot of expenses, maybe kids are in school, so he funds it at 20, repays the loan at 20. When the loan is paid back, there's your available line of credit increasing. Here's what folks typically like to look at. Year over year, growth compared to interest. By the second loan principal payment, my growth has exceeded the interest I'm paying annually. But then this guy is nice because I can compare the total gain on my policy with the total interest paid. Always a topic of interest. And then by year 9 here, between 8 and 9, is when I see myself in a positive situation overall. But really seeing the numbers and seeing what you're comfortable with is most important, in my opinion. Most important thing is always the start. Making sure the policy is set up correctly from a design perspective, that it's very flexible, and that we have the cash value maximized. If that's your goal, if that's why you're interested in a policy to maximize the cash value and then be able to use it, we want to make sure that that's done properly. Company selection is important too. 1, from a quality standpoint, but then 2, from flexibility, limitations and such. Hope you enjoyed this one. This was a lot of fun. Let us know if you did enjoy it. And as always, I hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.